Hey guys, it's Paul Cabral here. Remember I told you to buy Intel in like the 50s and 60s or whatever, and now it's like $26. Well, guess what? It went up on earnings, guys. Yeah, see, I was right. The stock went
up. Good morning, everybody. Welcome back to Strongman Personal Finance. My name is Christopher Bentley. I'm a certified CPA accountant. I'm a fake boglehead investor. I'm the author of the book Stop Being a Broke Loser. It's on Amazon. And we're going to go look at Intel Mindset. I can't say that word. Probably just got demonetized. We're going to go look at Intel's earnings. And I'm going to give you my honest thoughts. Because if y'all remember, I put a massive $500 YOLO into Intel, assuming its revenue would not collapse by any meaningful measure, right? And then the last quarter, Intel's revenue collapses by 20-something%. And I said, I'm out. And guess what? I lost $25. And my argument is if you invest based on a certain assumption or belief, and then that changes drastically, you should really reconsider your investment. Okay? So let's go ahead and check out Intel's. I just said it again. Man, do this whole video. Don't make any money. So here it is. Intel, third quarter GAAP revenue of $15.3 billion, down 20% year over year. And non-GAAP revenue, let me make sure I'm sharing my screen. Non-GAAP revenue of 15.3. Well, let's compare this to the prior quarter. So we go on this little website. It's pretty cool. And we see that last quarter they had 15.3, and now they have 15.3. So there's absolutely no change. Wait, these are correct earnings? Hold on one second. What was the bottom line? Net income 1. Okay, yeah, this is the prior quarter. Let's see. Q3. Let's say the freaking quarter on here. Whatever. Anyway, so revenue's down massively, right? It's down 20%. Now, if you remember, Paul, when he was doing his analysis, his DCF of Intel, he was putting in like 0% revenue growth, 2%, 4%, right? When something crashes this massively, it throws a massive level of uncertainty into Intel. 20% down. And the question is, will this continue? Because if you have conservative estimates of 0% revenue growth for the next 5 years, and then it actually drops 20% in the first year, 5% of the next year, 2% in the year after that, and then maybe goes up 1%, your whole DCF is completely freaking wrong. And you have to throw that out throw it out with the bathwater. So right off the bat, 20% down, freaking shocking, okay? But it gets worse because you look at gross margin. Well, gross margin also collapsed by 13.4%. And you can see that Intel's gross margin was pretty freaking good. I mean, because you look at this company, right? And it's like, okay, they're profitable. They have a high gross margin. Sure, their revenue's not growing, but they have a dividend, and I guess they're buying back shares, maybe. Well, we'll go check that in a second. But once again, if you're looking at all these past assumptions and you think that's going to continue in the future, or if it changes, you may need to consider selling. But at least they've improved their gross margin a little bit, because that last quarter when I sold, this was just like an unmitigated disaster, okay? So gross margin has actually improved, but it's well below their previous gross margin by leaps and freaking bounds. R&D. How much do they spend? Just a little bit more on R&D. Now, apparently they're trying to cut costs, but they're spending more on R&D. Got it. Operating margin. Look at this collapse. Look at this profit margin operating margin collapse. It went from 27% down to -1. Doesn't that concern anybody? Okay. Because I notice a trend. It's like, okay, in the past, their revenue was flat. And then all of a sudden I see their revenues start to go down a little bit, and their profit margin starts to decrease, and obviously their gross margin goes down. And now we go from this profitable company that looked good. I mean, look at this. If you looked in the past, and you did your little, DCF assumptions, you're like, oh, they're going to have flat revenue growth, and they're going to have 20, let's say 20, 22, and 24% profit margin. That makes sense, right? If you're looking in the past. But now we're in a new era, I think. And if you're relying on an old DCF that you did, and that's your primary tool of valuation, you're totally off them. You're so massively off the mark. Your whole thesis is out the window. Okay. I mean, look at that collapse in margin: 17, 25, 35, 22, 42. And now it's -1. Tax rate, 642%. Interesting. That's just it's obviously not that tax rate. And they had net income of 1. So I wonder if they had some kind of like tax benefit. I guess we can go look at the financial statements. So they had EPS of 0.25, basically because of taxes, or some kind of tax carry forward or something. So at the end of the day, while it looks profitable, they have net income. Their actual business before interest and taxes was in the red. So they only were profitable probably because of a tax benefit. Wow. Okay. Now let's see where Intel's getting absolutely wrecked. Client computing down 17%. Data center and AI group down 27%. Networking and edge up. Accelerated computer systems up. Mobileye, aren't they spinning that off? Up. Why is this even? Aren't they spinning off Mobileye? Why is it even in here? And then Intel Foundry down 2%. Okay. Blah, 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 blah. So the whole thesis behind Intel, if you're not looking at fundamental, you should always look at fundamentals. But, they're going to benefit from the CHIPS Act. They're building more fabs. And at some point in the future, they can potentially, come back. But you're going to have to wait multiple years and accept these terrible freaking margins potentially and potential declining revenue to finally get to that point. So you got to kind of have balls of steel to invest in this company. And you could be entirely wrong, because it really concerns me that this collapse in revenue is continuing and this collapse in profit is continuing. I don't know. Are they going to cut the dividend? If they cut the dividend, which maybe they did not even hear about it, that would be another disaster. Okay. Because a lot of people are probably buying Incel. Said it again. Because it's like they're probably buying it because of the freaking dividend. You can't tell me that clowns are looking at this like, oh, it's got a 5.56 yield. That means I get 5.56% returns. Andre G, I'm looking at you. So we'll see what happens with that. All right. I got a couple minutes. Let's see. Let's look at the financial statements. Okay. Revenue's down. Cost of sales is up. Let's see. Gross margin is massively down. R&D has gone up by decent, what is that? 10%, 15%. Marketing, flat. Restructuring and other charges. Wonder what that is. Let's see. Operating income, gain or loss on equity investments. So here's another thing that's you need to consider about Intel. When you have an equity investment, right? When it comes to accounting, there's different ways to account for investments. And depending on how much you own, let's say Intel buys another company, right? And they own like 5% of it. Well, they could potentially use the cost method where they only record dividends as income. So you only see like dividend income or other income or whatever on their financial statements. If you own, what is it? Between 20% and 50% or less than 50% of a business, use the equity method of accounting, where the business you own, you count that business's earnings as part of your earnings, the percentage that you own, and the dividends reduce your investment. Okay. So when you see this right here, whatever they had bought the prior year, those subsidiary or those businesses they have partial ownership in, they're not subsidiaries necessarily, were positive. They're profitable. A lot of whatever they own now is unprofitable. So, and this affects like Berkshire Hathaway too. Like you'll see this when the businesses they own are unprofitable for whatever reason, it'll reduce their earnings. So keep that in mind. You want to really pay attention to all the equity investments they own, because if they bought a bunch of crappy businesses and those businesses start to have worse and worse and worse profits, you're going to see bigger and bigger negative numbers here. But it's also the inverse. if the businesses they bought recover, you're going to see a massive increase in profit margin. Okay. Provision for, yeah. So basically they had some kind of like tax benefit, which is the only freaking reason they're profitable. So, they had earnings per share because of the tax benefit. And, did they issue shares? Oh boy, let's go look at their past. Weren't they like buying back shares or something earlier? Yeah, so the whole thesis, you look at everything money, right? And I even like initially, so I was like, oh yeah, in the past, you can't change that drastically, right? Boy, it was wrong. In the past, they were buying back shares, buyback. Now they're issuing shares, it looks like, at least according to this. They're issuing shares. That's a massive turnaround from buying back to issuing. And they're like, their revenue is going to be flat, or maybe grow at 1 or 2%. Now it's absolutely collapsed. They have a profit margin of this. Now the profit margin has drastically changed. It's gone from 25% in 2021 to who knows what in 2022. Every assumption that has gone into Everything Money's analysis of this company, and even me, I did like a stupid little DCF. I was like, okay, I'll put $500. We'll see what happens. Every assumption that I had changed massively, and I sold because at that point, you can't just bag hold something like that. Okay, when it changes that badly, you can't, because you're going to get absolutely freaking wrecked. So let's see. Look at the balance sheet. So we got, this is another thing Everything Money does. So they always check long-term liabilities to free cash flow. They don't even check the current ratio, which is actually very important because that tells you if a company could go bankrupt within a year. So you always want to check it. So you always look at current assets, okay, which have gone down, but not necessarily the end of the world. They've gone down to $49 billion, and their current liabilities are 27. So Intel's not going out of business, okay? That's fine. But you want to check that. You want to compare current liabilities to current assets to current liabilities. Because if you see there's a huge current liability here and you don't have many current assets, well, you're looking at a debt issuance event or potentially a massive dilution. So good to check. Let's see. What are the total long-term liabilities? That's annoying. Do they not sum it up for me and make it easy? Of course not. Well, they had the vast majority of their debt. It looks like it's $46 billion in long-term debt, something like that, $47 billion. And their long-term assets. Okay, so even in that regard, their long-term assets are well in excess of their long-term liabilities. That's another thing I look for because I don't like seeing a company that has a ton of long-term debt, but their long-term assets are below that because it's like owning a home. Like if you have a home, obviously you want your debt that you owe on your mortgage to be less than what you own on your, what you have as equity in your house. So from a debt standpoint, it's not the worst in the world. They're not going to go out of business. But if things continue to deteriorate and we see a collapse in current assets, I don't know. Let's see if they even have positive cash flow. Yeah, they issued shares. Oh, boy. This is not good. Statement of cash flows. So they still have positive cash flow from operations, right? That's fine. But it's massively collapsed. And if Intel starts to have negative cash from operations, which is entirely possible if this continues, how are they going to get cash? Well, they're going to have to cut capital expenditure. Well, that wouldn't affect the operating cash flows, but they potentially have to cut capital expenditures. They have to raise debt, or they have to issue more shares. Okay. So everything I see now is just not freaking good. Everything I see. Issuance of long-term debt. I don't know what to say, guys. I mean, I obviously got out of this because every single assumption changed. But if you want to continue to bag hold this, I mean, there's always the chance it turns around. And there's always the chance this is temporary, which is entirely possible. I mean, like there was a massive, huge demand for chips and blah, 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 blah during the pandemic. And a lot of companies benefited massively from that. And now we're kind of reverting back to where the companies would normally be had we not had the pandemic, which makes absolute sense to me. But you got to redo your assumptions, okay? You got to really study where you think the revenue, earnings, profits, and shares outstanding are going to go. Because all I see is absolute freaking trash. From massively profitable to unprofitable. From buying back shares to issuing shares. From flat revenue to the massively declining revenue. From decent gross margins to massively declining gross margins. I'm not buying the dip on this one. I'm sorry. Okay. I haven't done nearly enough research to see what's going on. And at the end of the day, I lost my $25 and that's about it. All right, let's do some comments. The spin off its fabs. Who freaking knows? Probably only their chip design, all their patents is worth. I miss most of your morning video. I mean, I usually don't make morning videos. And the fabs are probably losing money and having huge capex. Yeah, everything is bad right now. Okay, but even if everything stayed the same, but they were spending more on fabs, that may not be a bad thing because they're investing for the future. But it's all the other things that have changed: the revenue, the profit, the shares. All of that has changed. That's my concern, and that's why I got out of it. Intel's fallen Palantir business issuing shares to raise capital. They kind of have to because their operating cash flow has collapsed. Because you talk a little bit about depreciation affects the cash flow because it doesn't look like a cash gain. Yeah, so depreciation, let's go look. So depreciation is always an add back on the statement of cash flows. Because what depreciation is, a lot of people don't understand depreciation, which I think it makes perfect sense. Let's say you buy a building and you're going to use it for 30 years. Well, if you don't really understand accounting, you might be like, well, the building costs $10 million. So I'm going to write off the building in year one, right? Well, think about this. You're using the building for 30 years. So wouldn't it make more sense to expense the building to match the revenues or the, whatever it's generating over 30 years? Yes. So on the statement of cash flows, let's say you buy the building in cash. Year one, you're going to have a $10 million outflow down here on the investing activities. It'll be a negative 10,000 plus whatever other crap they buy. But up here, you're going to be expensing that building. You're recovering the cost of that building over 30 years. And that is a non-cash expense because you spent the cash, you bought the building in cash in year one, but for the rest of the time, you're not spending any cash. It's a non-cash expense. So when you're looking at the statement of cash flows, you're trying to figure out, how did my cash change? How did my cash get from here to here? And that's what the statement of cash flows does. So you have to add back non-cash expenses because you're not spending cash. This depreciation is on the income statement, but has nothing to do with cash because it was bought in year one with cash. And for the remainder of the 29 years, there's no cash. I mean, obviously, your maintenance, blah, 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 blah. And when it comes to the actual building itself, you're depreciating it. So that is why you have depreciation, and that's why you add it back. Same thing with stock-based compensation, blah, 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 blah. Amortization. It all follows the same concept. It's called the matching principle in accounting. You match expenses to the revenues. Boom, boom, boom. What's up with everything money? I don't know. I think Intel is a very odd case to me. Looking swole. Thank you very much. All right, I got to get to work, guys. We'll do a LaFufu outro because why not? And then have a wonderful day.
Oh, merry stock market. Oh, man.